Today, Bitcoin stretches back above the $58,000 mark as we close out the week. The House fails to override President Biden's veto of a bill that would end controversial SEC guidance, and Bill Barhydt of digital asset services firm Abra lays out what he thinks is keeping Bitcoin stuck below 60K. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto prices slightly in the green to cap off the week, filled with the release of economic data and testimony from Fed Chair Jay Powell on Capitol Hill. As of noon Eastern, Bitcoin reclaimed the $58,000 level. Ether climbed just under 0.5%, holding steady above $3,100, and Solana maintained the $138 level. For the week, Bitcoin is up more than 2.5%, and Ether is up 4.5%, outpacing the S&P 500 as of noon Eastern. All right, let's talk about the top stories. The House of Representatives failed to override President Biden's veto of a bill that would end the SEC's controversial Staff Accounting Bulletin 121. As a quick refresher, when he vetoed the bill back in May, President Biden said his administration would not support any measures that would, quote, jeopardize the well-being of consumers and investors. Well, weeks after President Biden vetoed the bill passed by both chambers of Congress, the legislation was back on Capitol Hill this week, where lawmakers needed a veto-proof majority, a two-thirds vote, for it to pass once again. But the House vote on whether to override the bill failed on Thursday, with 207 Republicans and 21 Democrats voting yes. That failure means the accounting policy remains in effect, given the turnout fell well short of the two-thirds vote needed. Next, the Securities and Exchange Commission ended its 3-year investigation into Bitcoin Layer 2 stacks and the development platform Hero. The SEC began its investigation into the two entities a couple of years ago after Stacks launched its first token offering when a new version of the Layer 2 hit the mainnet, and that's according to Stacks co-creator Manub Ali. In this 2021 SEC filing, the company said it was no longer providing essential managerial services to the Stacks blockchain, and therefore it was no longer necessary to treat the tokens as securities. Now, today's filing announcing the investigation's end includes an email attachment from the SEC from earlier this week, saying the agency has concluded the investigation as to the Stacks blockchain and that it does not intend to recommend an enforcement action against Hero. Hero said in a blog post today that, quote, for the past 3+ years, we've diligently complied with the requests for information and worked to explain how the Stacks network works and what Hero's role in it is. Hero's post also argued the importance of creating a clear regulatory framework in the US, and that the closing of the Stacks investigation gives hope for a bright future for Bitcoin and the next generation of the internet. Last, Chainalysis just published its first money laundering report exploring trends and behaviors in crypto AML. The 30-page report shows that since 2019, nearly $100 billion in funds have been sent from known illicit wallets to conversion services. The blockchain data platform says the value of illicit flows to bridges has increased steadily over time, with a pronounced surge in illicit value starting in late 2023, with close to $234 million in illegal inflows recorded in January of this year. That's the highest value to date, which Chainalysis says is largely driven by funds flowing from crypto mixer Tornado Cash to bridges. The report also highlights the role of technology and innovation in money laundering prevention, noting that data analysis, quote, plays a crucial role in identifying and neutralizing the most pressing threats in the crypto ecosystem, where a single wallet address can illuminate a vast network of criminal abuse. The report goes on to say that by leveraging advanced technology, managing compliance, and investing in education, the crypto ecosystem can achieve a sustainable and secure framework that protects against illicit activities. All right, let's jump back to markets for our main story. Despite this week's gains, both Bitcoin and Ether are in the red for the month of July so far. To find out more on why, I spoke with Bill Barhydt of Abra, a global platform for digital asset prime services and wealth management. All right, Bill, thank you for being here. I want to start with just your reaction to where we are with prices. You know, a lot of people we spoke to in Crypto World have said that after the halving, investors should be prepared for a few lagging months before we see new highs. And you know, Bitcoin is down 6.5% so far this month. Ether's down about 8%. Just walk me through how you're looking at the crypto market right now.
Sure. As it relates to Bitcoin and macro, I think there's three things that matter right now. The first is that coming into 2023, we really saw a bottoming in global liquidity. And it's really what happens at the margins that matters if you understand macro. And so that trough really led to a great year in 23. As liquidity increased, as there was growing excitement for potentially at the end of the year, the ETFs, and, you know, just general excitement for what happens, you know, in the halving cycle. So that all played out, right? And then coming into 23, we probably had I'm sorry, coming into 24, I think we had kind of a temporary peak given interest rates in global liquidity, combined with an offset on the ETF, which I think was more successful even than people had imagined. And people underestimated the tax implications for people withdrawing from Grayscale. And so the fact that those redemptions didn't happen and the inflows were there kind of offset the kind of peak in liquidity. And then the third part is the traditional halving cycle. And there, the most important point, and this is still playing out because we've such short-term memories in crypto, but the halving just happened. And traditionally what happens is there's a reset among miners. Hash rate pulls back, miners can't afford to mine, they're forced to sell. Remember, they're earning explicitly half of what they used to earn for, and sometimes more work, given the euphoria around the ETFs, which actually had more miners coming online. That's causing a pullback now in hash rate. I think that the hash rate is about to trough, if it hasn't already, which usually signals the bottom post-halving. And that's great news because this is a smaller pullback than what we've seen on a relative basis in other post-halving cycles. So that, combined with the fact that the macro picture says we're seeing a significantly softening economy, says liquidity has troughed, hash rate has troughed, liquidity is about to increase, and I don't think there's going to be more miners coming offline. And we're still under the mining price, meaning it costs 50K and change to mine a block, and they're earning more than that. So that's good news, right? So all of this purports to a really interesting second half of the year to me, where I expect to see risk on assets appreciate significantly, and Bitcoin has always been kind of a levered bet on risk on assets anyway, in terms of sucking up that liquidity.
Yeah, I'm curious about that conversation around interest rates in the macro environment. I mean, in recent days, we had the inflation data come out that lends credence to this idea that the Fed would start cutting rates later this year. But how much do you think that conversation still plays into crypto, if at all? Because, I mean, for so long, investors in the crypto space were watching the Fed, and then for a while, it felt like all eyes were off. You feel like that actually matters again?
It does, but at the end of the day, crypto has created too many couch potato macro analysts that don't really understand cycles in detail, right? So you got to look at the PMI, you got to look at interest rates, you got to look at global liquidity. What's China doing? What's Japan doing with their traditional yield curve control, activities? And when you play all of that out, we have to refinance, hundreds of billions of dollars worth of debt at much higher rates, and if we don't get those rates down via something like yield curve control or something else, we have a big structural problem. So all that basically points to the fact that we're going to have more liquidity in the system. We're going to have more money printing. And if we don't, it's going to be a disaster. And we're not willing to take the pain that it would take for that not to happen, which would be, massive cost cuts across the board in the West. And that's not going to happen. So unless there's something structural that breaks, we're in for significant, either quantitative easing or whatever they're going to call it the next cycle.
I want to shift gears to something that happened earlier this month. Abra launched a treasury service at the beginning of July aimed at companies wanting to hold Bitcoin on their balance sheets. We talked a lot on Crypto World in the past about institutional adoption, but I want to hear from you about where we are on that front and how the companies you're speaking to feel about crypto right now. Yeah,
so it's really been an interesting cycle because we're seeing, kind of post what's happened with MicroStrategy, a whole bunch of particularly mid-cap companies, even nonprofits, come to us and say, hey, look, we saw your announcement about your new registered investment advisor, the separately managed accounts. Separately managed account basically in English means that you retain title to your assets. So all the shenanigans that happened with the Celsius, BlockFis, Voyagers, whatever, can't happen because you're not on my balance sheet. And they love that model for holding crypto. And so they said, okay, I've seen the stock appreciation for MicroStrategy because they've effectively, put Bitcoin on their balance sheet, and that cash is always discounted to zero, right? Markets traditionally discount cash in your balance sheet to zero, right? Because it's a depreciating asset. But if you replace that with an appreciating asset, and what happens to be the apex predator, as Michael calls it, of appreciating assets, now all of a sudden, they don't get discounted to zero. It gets a bump and a bonus for being on your balance sheet. And so we've seen several mid-cap public companies' stock get a huge bump overnight, 20, 30, 40%, by by replacing the cash with Bitcoin. That's point one. Point two is we've even seen nonprofits now. We have a couple in our system that have started to convert treasury into Bitcoin, and they intend to hold that forever if they can and actually borrow against the Bitcoin, right? So they can fund their operations by borrowing a depreciating asset against the value of an appreciating asset. And I foresee a lot of mid-caps, nonprofits doing this, and you're going to see significant increases in their stock value for those companies that have, 9, maybe low 10 figures of dollars in their treasury that's effectively being discounted either to zero or significantly, is now going to see a significant increase in its value because they're going to convert it to Bitcoin.
All right, that's all for Crypto World this week. We'll be back on Monday, and we'll see you then.